Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 169, recorded on June 8th, 2025. This podcast is for entertainment only and is not investing advice, so please do your own homework. We're at block height 900,368, Moscow time 9:40. Fees are 1, 1, and 2. We'll begin with the market news update outlook, get into the weekly Bitcoin news, a little bit lighter than last week. We'll check out this week's featured post on the Bitcoin Fortress Substack, take a look at what's coming up on the Bitcoin Fortress Substack. We'll do some shout out and then wrap it up. So let's get into it. Wall Street on Friday closed out a solid week of gains on a high note, with the benchmark S&P 500 index reclaiming the 6,000 points level for the first time since late February. Sentiment this week was buoyed by positive developments on the trade front and encouraging labor market data after tensions between the US and China escalated following Trump's accusation that China had violated a temporary trade truce. The presidents of the world's two largest economies held a phone call on Thursday. Trump said it was a very good phone call and that Xi Jinping had invited him to visit China, an offer that he reciprocated. Trump on Friday said members of his administration would meet Chinese officials for another round of trade talks in London on June 9th. Turning to labor market updates, job openings in April came in higher than expected, while also accelerating from March. On the other hand, the pace of private hiring in May reached its lowest level since March 2023. Finally, on Friday, the all important May non farm payrolls report came in stronger than anticipated. Another notable event this week was Circle's initial public offering. The stablecoin issuer saw a blockbuster market debut in which its shares more than doubled in value on the New York Stock Exchange. We'll go into that in a little bit more detail later. For the week, the S&P 500 advanced 1.5%, while the tech-heavy Nasdaq Composite climbed 2.2%. The blue chip Dow added 1.2%. Looking ahead, Wall Street's attention next week will be on further trade developments and key inflation data. U.S. and Chinese officials, including U.S. Treasury Secretary Scott Bessent, Secretary of Commerce Howard Lutnick, Trade Representative Ambassador Jameson Greer, and Chinese Vice Premier He Lifeng are set to meet in London on Monday. Investors will be keeping a close eye on the talks. The last round of discussions had resulted in a surprise temporary trade truce, boosting market sentiment. Turning to the economic calendar, traders will receive May readings for the Consumer Price Index and the Producer Price Index. The earnings season next week is highlighted by video game retailer GameStop, cloud software firm Oracle, and Photoshop creator Adobe. Also grabbing the spotlight will be Apple's WWDC 2025, kicking off on Monday. The event is expected to feature major announcements and a first look at new updates for iOS, iPad OS, Mac OS, Watch OS, TV OS, and Vision OS. Jumping into the Bitcoin news, this is the Hodler's Digest for June 1st through 7th from Cointelegraph. We'll see what's in here that's interesting. Metaplanet, also known as Japan's strategy, has updated its Bitcoin acquisition plans to acquire 100,000 Bitcoin by the end of 2026. Metaplanet on June 6th posted its new Bitcoin plan, increasing its previous target of 21,000 Bitcoin. We'll jump into that in a little more detail later on. Cryptocurrency exchange Gemini, headed by Tyler and Cameron Winklevoss, has filed for an initial public offering with the United States Securities and Exchange Commission, according to a June 6th press release. Gemini filed a confidential draft registration statement on SEC Form S1, which allows the company to file for an IPO before publicly disclosing sensitive information. The filing comes amid renewed investor confidence as uncertainty due to trade wars has waned. The number of shares to be offered and the price range per share have not been determined. No date was mentioned for when the IPO might occur. A man suspected of being a key figure behind a series of recent crypto-related kidnappings in France has been arrested in Morocco. At the request of French authorities, Morocco's National Police and Intelligence Service arrested Badis Mohamed Amide Bajou, a 24-year-old French-Moroccan man who was reportedly found in possession of multiple bladed weapons and several mobile phones. France's Minister of Justice, Gerald Darmanin, praised the arrest in a June 4 X post after French news outlet Le Parisien reported the arrest. I sincerely thank Morocco for this arrest, which demonstrates the excellent judicial cooperation between our two countries, particularly against organized crime, Darmanin said. The U.S. Securities and Exchange Commission has been handed a $1.1 million court victory after a man it accused of running a crypto scam failed to answer the agency's lawsuit. A Georgia federal court judge submitted a default judgment in the SEC's favor on June 3rd in its case against Keith Cruz, who failed to respond or defend himself against the SEC's lawsuit that filed in August 2023. Judge Tiffany Johnson ordered Cruz to pay financial penalties of over $1.1 million, finding him liable for disgorgement of $530,000 in net profits from his alleged misconduct, and ordered him to pay prejudgment interest of almost $51,000 and a civil penalty of $530,000. The judge ruled that Cruz is also permanently banned from future violations of securities laws. The millionaire leveraged crypto trader James Nguyen has been liquidated of nearly $25 million in Bitcoin after betting with leverage that the cryptocurrency's price would rise. Nguyen was liquidated for 240 Bitcoin and had manually closed part of his position to lower the liquidation price, on-chain analytics platform Look On Chain posted to X on June 4th. Look On Chain added that Wynn still held 770 Bitcoin worth around $80.5 million dollars at a liquidation price of 104,035. Data from Hyperscan shows that the trader is currently sitting on an unrealized loss of nearly $1 million on his 40x Bitcoin long position. When will they ever learn? Let's see. Here's some quotes of the week. Let's see what these are. Stablecoin will be one of the strongest places that I would invest long term. This is from Alice Lee, investment partner and head of North America at Foresight Ventures. If your business model can't handle a 80% Bitcoin drawdown, rework your business model right now because I think we're getting toward the very shaky ground of the top and the fall from it. This is from Safetine Amos, author and Bitcoin educator. Always wise advice. Don't over-lever yourself because Bitcoin can do crazy things. Retail investors' appetite for risk is much lower because we know what happened with the stock market and every other aspect. This is from Vugar Usizadeh, Chief Operating Officer at BitGet. With long-term holders gradually applying sell pressure, the probability of a short-term correction continues to build, particularly in the absence of a strong upside catalyst to push Bitcoin decisively above 111,800. And this is from Glassnode. We're still in the study phase, I'd say, but stablecoin is one of the, for me, more interesting instantiations of crypto that has a practical benefit other than crypto as a store of value. And this is from Dara Khosrowshahi, who's the CEO of Uber. There are generals, especially in Southeast Asia, who believe it's important to have a strategic Bitcoin stockpile because we're doing an economic war with China and we have to prepare for a guns and bullets war, but we need both. Cynthia Lummis, U.S. Senator. Let's see. Top prediction of the week. Bitcoin climbed towards 105,000 on June 6th. after plunging to its lowest level in 4 weeks the previous day. Traders questioned whether the sharp decline had been coordinated, especially following reports that U.S. President Donald Trump and Chinese President Xi Jinping had resumed discussions over import tariffs. The reasons behind Bitcoin's sudden drop on June 5th might never be fully clarified. Still, several contributing factors emerged, including fears of a potential economic recession, continued uncertainty surrounding the U.S. strategic Bitcoin reserves, and speculation that custodians might be engaging in rehypothecation practices. Uh-oh. If these concerns are valid, a quick return to the $110,000 level appears unlikely. U.S. authorities seized 145 domains and an undisclosed amount of cryptocurrency tied to Biden Cash. Biden Cash. A dark web marketplace accused of trafficking millions of stolen credit cards and personal data. The action announced on June 5th by the U.S. Attorney's Office for the Eastern District of Virginia followed a court-authorized operation targeting the platform's infrastructure and financial flows. The seized domains are now redirected to a law enforcement-controlled server. Biden Cash, launched in March 2022, had grown to over 117,000 users and facilitated the sale of more than 15 million stolen payment card numbers and other personally identifiable information. The platform generated over $17 million in revenue during its operation, according to U.S. officials. The derivatives arm of crypto exchange Crypto.com has sued the Nevada gaming and gambling regulator over its restriction on the trading of sporting event contracts. North American Derivatives Exchange Inc., which does business as Crypto.com's North American derivatives business, sued the Nevada Gaming Control Board in the state's federal court on June 3rd, claiming it improperly blocked the exchange from offering derivative contracts that reference sporting events on its federally regulated market. It claimed the regulator asserted jurisdiction with the mistaken premise that contracts traded on the exchange constitute wagering on sporting events, subject to Nevada gaming laws. Crypto.com argued that federal law, specifically the Commodity Exchange Act, grants the Commodity Futures Trading Commission exclusive jurisdiction over these types of financial instruments. Ukrainian police have arrested a man and accused him of hacking the accounts of an international hosting company and using its servers to mine crypto in an apparent case of cryptojacking. Cyber police officers from Ukraine's National Police said in a June 4th statement that a 35-year-old man from the Poltava region had allegedly been probing for weaknesses in the online security of various international companies and gaining access to their servers since at least 2018. In particular, the defendant illegally gained access to over 5,000 customer accounts of an international hosting company that provides server rental services for the operation of various websites and online platforms, the police said. And a couple little news bites. Wealthier and highly financially literate baby boomers are having a big impact on Bitcoin markets, but the majority remain skeptical. Traders get wrecked by Gate.io's LA token perpetual contract price bug, Philippines crypto influencer crackdown, and more. And finally, one expert tips AI will replace workers and cause a global population collapse, but PwC research shows you can get a big raise using AI at work. And that wraps up the Hodler's Digest. Moving on. This is from Cryptopotato, a week in review. So we'll see if there's anything new here that would be interesting. Although the week started in a sluggish manner, it quickly became an interesting one, especially when the soap opera at the highest levels in the United States took place. Yet the drama that unfolded between the US president and one of his closest allies managed to impact the crypto markets as well. But before we go into the details of the quickly escalating spectacle between the two, let's rewind the clock slightly to the events that transpired since last Friday. Bitcoin's price was quite calm at that point, and after the few rejections at around 110 in the previous week, it had found a solid spot close to 104. It sat there for about 72 hours and started to gain traction as the new week began. However, it couldn't go any higher than 106.5, where it was stopped on a few occasions, even yesterday, after the European Central Bank announced an eighth interest rate cut, dropping the metric to a 2 year low of 2%. Bitcoin managed to climb to only 106. It faced immediate selling pressure at that point and slumped to a multi-week low of 100,400. Of course, the blame for this substantial correction was put on the aforementioned drama between Musk and the POTUS. Both men used their respective social media platforms to fire shots at one another. Some of the most notable include Musk saying Trump was in the Epstein files, while the president threatened to halt the former's government contracts. More recently, Trump denied rumors that he plans to hash it out over a phone call, and the other reports even emerged claiming that he plans to sell his Tesla EV. Despite the ongoing saga, Bitcoin managed to recover some ground and now trades around 104. This represents a 1.7% decline on a weekly scale, but it's minimal compared to the substantial losses experienced by Doge and some of these other shitcoins. So here's some headlines. No price spike, but 22,500 Bitcoin quietly left exchanges in a single day. Although Bitcoin's price is yet to react, the amount of Bitcoins heading out of exchanges and going into self-custodial devices continues to impress. In a single day alone, over 22,500 Bitcoin were moved from trading platforms, which reduces the selling pressure. On-chain data signals buy the dip as Bitcoin hash rate hits new highs. Bitcoin's price tumbled, as mentioned above, but this week to a June low of under 100,500. However, an important on-chain metric, the Bitcoin hash ribbons indicator flashed a buy the dip signal, and people did buy the dip. ECB cuts interest rates again. How did Bitcoin react? Well, while the US Federal Reserve continues to leave the local interest rates unchanged in 2025, the European counterparty went in the opposite direction. The ECB lowered the rates in the Eurozone to 2%, the lowest in over 2 years, and Bitcoin jumped initially before going down a notch. Robinhood cements crypto ambitions with 200 million Bitstamp takeover. Robinhood solidified its presence in the European crypto market by acquiring the world's oldest, still functioning digital asset exchange, Bitstamp. The deal announced earlier this week was for $200 million. Bitcoin sees intense surge in realized profits following ascent to 111K, according to Glassnode. With Bitcoin falling further away from its latest all-time high registered a couple of weeks ago on Bitcoin Pizza Day, reports have emerged now claiming that the most probable reason behind this is that profit taking has gone through the roof after the price surge. And Strategy announces proposed IPO of STRD stock to buy more Bitcoin. And we'll get into that in a little bit more detail later. Next up from Bitcoin.com news. If it keeps the pace, BlackRock's IBIT is on track to seize 1 million Bitcoin by early 2026. Based on current data, the 12 US spot Bitcoin exchange traded funds collectively manage over 1.2 million Bitcoin, yet two in particular, BlackRock's IBIT and Fidelity's FBTC, command a striking majority, accounting for more than 71% of that aggregate. BlackRock's IBIT debuted on Wall Street on January 11th, 2024, exactly 1 year, 4 months, and 26 days ago. As of data collected on June 5th, 2025, the firm's iShares Bitcoin Trust ETF controls roughly 662,707.41 Bitcoin, translating to 69.2 billion in value. This single ETF alone accounts for 55.23% of the 1.2 million Bitcoin managed by the 12 publicly traded Bitcoin funds. IBIT's holdings comprise 3.16% of Bitcoin's 21 million fixed supply and 3.34% of the 19,875,085.22 Bitcoin in circulation at the time of publication. No other crypto exchange traded product has achieved this scale of accumulation this fast, although IBIT and its peers trade 5 days a week, observing holidays and pauses. If IBIT had been acquiring Bitcoin every calendar day since January 11, 2024, its daily haul would be approximately 1,200 or sorry, 1,296.88 Bitcoin over that stretch. If this cadence continues, BlackRock's ETF is projected to reach 1 million Bitcoin by February 21st, 2026, just 260 days from now, representing 4.76% of Bitcoin's hard cap. Fidelity's FBTC, by contrast, has taken a more tempered route. Over the same 1 year, 4 months, and 26 days, it has gathered 196,264.34 Bitcoin, currently worth just over $20 billion at prevailing rates. Applying identical calculations, FBTC has averaged 389.34 Bitcoin per day since January 11th, 2024. While FBTC holds the distinction of being the second largest US Bitcoin ETF, its trajectory has been far more measured than IBIT's accumulation. Should it maintain this current rhythm, FBTC would hit the 500,000 Bitcoin milestone by around July 18th, 2027. Consider Strategy, formerly MicroStrategy, which initiated its Bitcoin acquisitions on August 11th, 2020. Averaged out, this translates to a daily accumulation of 330.09 Bitcoin. If that same trajectory holds steady, Strategy will not cross the 1 million Bitcoin threshold until October 27, 2028. The accelerating competition among major financial institutions for Bitcoin dominance hints at a deeper strategic shift unfolding beneath the surface. With accumulation timelines now plotted years into the future, these ETFs are not merely chasing assets, they're staking claims in a digital monetary order. What began as a race for returns may well evolve into a contest over monetary influence itself. Next up, from the Daily Hodl, this is from June 6th. Michael Saylor's strategy announces $979,700,000 stock offering in a bid to acquire more Bitcoin. The world's largest corporate Bitcoin holder is announcing a new stock offering worth hundreds of millions of dollars as a means of accumulating more of the crypto king. In a new press release, Strategy, formerly known as MicroStrategy, is announcing the stock offering of 11.764 million shares of its 10% Series A perpetual Stride preferred stock, or STRD stock, for $85 per share. Strategy estimates that it will acquire about $980 million from the offering, which may give investors quarterly dividends, and intends to use the money for miscellaneous corporate expenses and to acquire more of the top crypto asset by market cap. Preferred stock offerings, which offer investors higher and more consistent returns as well as stability, are a way for companies to raise funds without weakening their voting rights. Strategy, which was co-founded by former chief executive and longtime BTC Maxi Michael Saylor, currently holds 580,955 Bitcoin, worth just over $60.5 billion at time of writing, coming in at an average cost basis of $40,680 per token, according to data from BTC tracking website Bitcoin Treasuries. The data also shows that Strategy currently holds about 2.7% of Bitcoin's total supply. Last month, Saylor announced that Strategy doubled the amount of capital it wants to accumulate to purchase more of the flagship digital asset from $42 billion to $84 billion. Bitcoin is trading for 104,540 at the time of writing, a 2.1% rise during the last 24 hours. Next up, from Decrypt. This was posted June 6th. Metaplanet aims to raise $5.3 billion to buy more Bitcoin. Japanese Bitcoin treasury Metaplanet has introduced a plan to add to its already significant holdings of the asset, part of a recent surge of companies that are increasing their totals. The Tokyo Stock Exchange listed company said it was looking to raise $5.3 billion by issuing 555 million shares through stock acquisition rights. In a post on the social media platform X, the company's CEO Simon Jarovich said that the pricing of stock acquisition rights issuance above market was a notable departure from the typical 8 to 10% discount of similar financings. Bitcoin sets a new benchmark for capital formation, he wrote, adding that Bitcoin uh, uh, oh, let's see. Oh, here's a quote from his X post. Metaplanet has executed Japan's first ever stock acquisition rights issuance priced above market, a notable departure from the typical 8 to 10% discount seen in similar financings. The structure is both shareholder friendly and unprecedented in scale. Metaplanet, which has been dubbed Asia's MicroStrategy, started buying Bitcoin last year and now holds 8,888 Bitcoin, worth nearly $934 million at today's prices. Last year, it pivoted from its core hotel and technology business to become a Bitcoin treasury. It is aiming to acquire 210,000 Bitcoin, about 1% of overall supply, by 2027 as part of a master plan. Metaplanet ranks among the best-known Bitcoin treasuries, a firm that buys and holds Bitcoin and allows shareholders to get exposure to the asset without the risks involved in holding it directly. The company has followed a path popularized by Nasdaq-listed Strategy, formerly MicroStrategy, which started buying Bitcoin in 2020. Strategy now almost exclusively works to buy Bitcoin, and investors buy its stock as a proxy to the leading cryptocurrency. It's the largest corporate holder of Bitcoin with 580,250 virtual coins, or nearly $61 billion worth of the asset. Bitcoin was recently trading for a little over $105,000 per coin, up 1.1% over the past 24 hours. It started rallying after a 2-week slump in which it dropped 4%. Metaplanet stock was recently trading up by 24% on Friday, according to Yahoo Finance data. The company's share price has risen more than 600% over the past year. So the Bitcoin treasuries are happening. Next up, CoinDesk. Let's see, this article was published on June 5th. Circle shares surge on NYSE debut, signaling strong appetite for stablecoin issuers. Shares of Circle began trading on the New York Stock Exchange on Thursday, opening at $69 a share in early trading. The stock at one point surged to as much as $100, more than 200% above the $31 price it had set the night before. Company announced late Wednesday that it sold roughly 34 million shares in its initial public offering, raising $1.1 billion dollars and landing a valuation of $6.9 billion. The listing marks Circle's long-awaited arrival on public markets after previous attempts, including a failed SPAC deal in 2021. Kathy Wood's ARK Investment Management expressed interest in buying as much as $150 million worth of the Circle shares, with BlackRock also intending to buy 10% of the shares, according to SEC filings and Bloomberg. The IPO draws comparisons to crypto exchange Coinbase's 2021 IPO on NASDAQ, which saw a volatile session with shares trading as high as $430 before tumbling to $200 one month later. Elsewhere, crypto-linked stocks, including Coinbase and Strategy, along with Bitcoin, were trading lower on Thursday. Circle's shares seem to have stabilized around $80 to $83 per share. Circle's debut lands in a market still wrestling with an uncertain macroeconomic environment. Earnings season is winding down, and more companies have flagged weak outlooks for the next quarter than strong ones, suggesting that U.S. stocks could face added pressure in the months ahead. However, Circle's core business, issuing the dollar-pegged USDC token, is benefiting from a different trend. Demand for stablecoins has grown in 2025, partly due to progress on U.S. regulation. Policymakers have signaled they're moving closer to establishing clearer rules, which could help legitimize and expand the use of stablecoins in mainstream finance. Deutsche Bank predicted in a report last month that stablecoins are on the verge of going mainstream. The bank cited their growing role in digital payments, cross-border settlement, and treasury management, while also reinforcing the US dollar's dominance globally. Circle's IPO may be early evidence of that shift. An investor bet not just on a crypto company, but on stablecoins becoming essential financial infrastructure. Moving on. This is from bitcoinnews.com. This was posted on June 6th. JP Morgan reportedly to accept Bitcoin ETF shares as collateral. Jamie Dimon is the big Bitcoin hater, but looks like his company is going to be doing some things. So, JP Morgan Chase, the largest bank in the US and one of the most powerful institutions in global finance, is going deeper into Bitcoin. The bank is reportedly going to allow wealthy clients to use shares of Bitcoin ETFs, specifically BlackRock's iShares Bitcoin Trust, as collateral for loans. This is a big move from the Wall Street giant and a sign of how traditional finance is changing the way it treats Bitcoin. According to a Bloomberg report, JP Morgan will let trading and wealth management clients borrow money using digital asset ETFs like IBIT as collateral, the same way clients might use stocks, real estate, or even cars. The bank will also factor clients' digital asset holdings into calculations of net worth and liquidity. So now Bitcoin will be treated like real estate or company shares when assessing a client's loan repayment ability. This is set to launch in the coming weeks and will start with IBIT, which has over $70 billion in assets. IBIT is now the largest spot Bitcoin ETF in the world and has far outpaced competitors like Fidelity's FBTC. Previously, JP Morgan only allowed Bitcoin ETFs as collateral on a case by case basis, Bloomberg reports. This decision will now make it available to all wealth management clients. JP Morgan's new Bitcoin friendly strategy comes despite its CEO Jamie Dimon's longtime skepticism of Bitcoin. For years, Dimon has been one of the most vocal critics of Bitcoin, calling it a tool for criminals and comparing it to a pet rock. But in a change of heart, Dimon recently said the bank would allow clients to buy Bitcoin. At JP Morgan's annual investor day, he said, "I don't think you should smoke, but I defend your right to smoke. I defend your right to buy Bitcoin." Great. While Diamond remains personally unconvinced about the long term value of Bitcoin, the bank seems to be moving forward with embracing Bitcoin because there's money in it. Come on. A move Bitcoin advocates believe is rooted in fear of missing out on possible profits, bingo, and losing market share. JP Morgan is following the trend on Wall Street. Other big financial players like Fidelity, Grayscale, and Standard Chartered have launched services for clients to invest or trade Bitcoin. The approval of Bitcoin ETFs by the US SEC in 2024 has opened the door to millions of investors who were hesitant to enter the Bitcoin space. Institutional interest is surging as the political landscape is also opening doors for digital assets. Under President Donald Trump's administration, several Bitcoin friendly policy changes have been introduced. In April 2025, the Federal Reserve withdrew past guidance that discouraged banks from working with digital asset companies. Soon after, the U.S. Office of the Comptroller of the Currency confirmed banks could hold customers' Bitcoin in custody. So institutional adoption continues. Last article is from Bitcoin Magazine. This is posted on June 6th. Bitcoin Layer 2, ARC. ARC is a novel off-chain transaction batching mechanism originally proposed by Burak, a young Turkish developer. There are currently two implementations being built, one by ARC Labs and the other by Second, neither of which Burak is involved with. The original proposal for ARC was much more complicated and involved some design goals more focused around privacy than the implementations currently being built. It was also originally envisioned to require check template verify in order to be built. The protocol depends on a central coordinating server in order to function properly, but despite that, is able to provide the same functionality and security guarantees that the Lightning Network does. As long as the user stays online during the required time period at all times, unless they choose to trust the operator for short periods of time, every user is capable at any time of unilaterally exiting the ARC system at any time and taking back full unilateral control of their funds on chain. Unlike Lightning, Arc does not require users to have pre-allocated liquidity assigned to them in order to receive funds. An ARC user can simply onboard to a wallet and receive funds immediately with no liquidity pre-allocation at all. Let's walk through the three different constituent pieces of ARC. Coins held on ARC are called virtual UTXOs. These are simply pre-signed transactions that guarantee the creation of a real UTXO under the unilateral control of a user once submitted on-chain, but are otherwise held off-chain. Every user's VUTXOs are nested inside a tree of pre-signed transactions or a batch. ARC works by having the coordinator server or ARC service provider facilitate the coordination between users necessary to create a batch. Whenever users are receiving funds, onboarding to ARC, or offboarding, it is necessary to construct a transaction and the associated transaction tree to create a new batch. The tree is constructed to take a single root UTXO confirmed on-chain, locked with an N-of-N multisig, including all users holding VUTXOs in the tree, as well as the ASP, and slowly split into more and more UTXOs until eventually reaching the leaves, which are each user's VUTXO. Each VUTXO is guaranteed using a script that has to be signed by a 2 of 2 multisig, one key held by the user and the other by the ASP or just the user after a time lock. Each time the tree splits, VUTXOs are created on chain, but so are more internal UTXOs that have yet to actually split into VUTXOs. Each of these internal UTXOs is locked with an N-of-N multisig composed of the ASP and all users who have a VUTXO further down the tree. During the batch creation process, users start at their respective VUTXOs and go through a signing process all the way back down to the root of the tree. This guarantees that the root will never be signed before each user's claim to a VUTXO is, ensuring they always have unilateral access in a worst case scenario to their funds. Each batch also has an expiry time, which will make sense in the next section. This expiry spend path, which exists as an alternate spending condition for the root UTXO on chain, as well as every internal UTXO, allows the ASP to unilaterally spend all funds by itself. When it comes to transacting on ARC, there are two possible mechanisms that are both with their own costs and implications in terms of security model. There are out-of-round transfers or pre-confirmed transactions, and there are in-round transfers or actually confirmed transactions. To conduct an out-of-round transfer is a very simple process. If one user, Alice, wants to pay another, Bob, they simply contact the ASP and have them co-sign a transaction spending the VUTXO to Bob. Bob is then given that pre-signed transaction as well as the other ones preceding it back to the batch root on chain. Bob is now capable of unilaterally exiting the ARC with this transaction, but he must trust the ASP not to collude with Alice to double spend it. These out-of-round transactions can even be chained multiple times before finally confirming them. To finalize an ARC transaction, users have to engage in a batch swap. Users cannot actually trustlessly confirm a transfer within a single batch. They have to atomically swap a VUTXO in an existing batch with a fresh VUTXO created in a new batch. This is done using the ASP as a facilitator of the swap and with the aid of what's called a connector input. When a user goes to finalize the ARC transaction with a batch swap, they relinquish control of the VUTXO to the ASP. This could be problematic. What is to stop the ASP from simply keeping it and not giving them a confirmed VUTXO in a new batch? The connector input. When a new batch is created, a second output is created in the transaction that is confirmed on chain, instantiating a new tree composed of connector UTXOs. When Bob goes to sign over a forfeit transaction to the ASP to conduct the batch swap, the transaction includes as an input one of the connector UTXOs from the new batch. This creates an atomic guarantee. Bob's confirmed VUTXO is included in a batch in the same transaction the connector input is created in that is necessary for his forfeit transaction to be valid. If that batch is never created on chain, i.e., Bob never actually receives the new confirmed VUTXO, then the forfeit transaction he signed for the ASP will never be valid and confirmable on chain. All of the liquidity necessary to create new batches in order to facilitate transfers between users is provided by the ASP. They are required to have enough liquidity to create new batches for users until old ones have expired, and the ASP can unilaterally sweep them to reclaim old liquidity previously locked up to create VUTXOs for users. This is the core of the liquidity dynamic at the center of the ARC protocol. While in one sense this is a massive efficiency win, not requiring liquidity providers to assess users and essentially guess which ones will actually receive large volumes of payments before they can receive any funds. In another, it is an efficiency loss as the ASP must have enough liquidity to continue creating new batches for users for however long they configure the expiry time to be, and they can start reclaiming allocated liquidity. This can be mitigated to a decent degree by how often an ASP offers to create new batches to finalize pending transactions. In the event of an ASP attempting to create new batches in real time as transactions are coming in, the liquidity requirements would be exorbitantly high. However, an ASP can lower the frequency of which they create new batches and drastically lower their liquidity requirements. This dynamic also has implications for block space use. Unlike Lightning, which can provide strong confirmation guarantees entirely off chain, in order for an ARC transaction to have an equivalent trustless degree of finality, a new batch has to be created on chain. This means that unlike Lightning, where transaction volume does not reflect itself on chain, the velocity of ARC transactions inherently requires a proportional amount of block space use, albeit in a very compressed and efficient manner. This creates a theoretical upper limit of how many ARC batches can be created during any given time interval, although ARC trees can be smaller or larger depending on this dynamic. Arc presents, in many ways, an almost opposite set of trade-offs to the Lightning Network. It is a massive block space efficiency improvement for off-chain transactions and does away with the problem of liquidity allocation on the Lightning Network, but it does have a much closer tied throughput limit that is correlated with the blockchain's throughput limit. This dynamic of almost opposite trade-offs makes it a very complementary system to the Lightning Network. It can also interoperate with it, i.e., VUTXOs can be swapped atomically in transactions entering or exiting the Lightning Network. Ultimately, how it fits into the broader Bitcoin ecosystem is yet to be seen, but it is an undoubtedly valuable protocol stack that will find some functional niche, even if it's different than originally intended. Wow, that's pretty interesting. I will include a link to this as well as all the other things I went over in the show notes. You may want to read this and actually look at the diagrams that they have in here. It makes it a little bit more understandable. Next, wanted to highlight this week's featured post on Bitcoin Fortress Substack. Post is quite simply entitled "Bitcoin is Hope." And I will include a link to that in the show notes. Looking ahead at what's coming up on the Bitcoin Fortress Substack, we have Finding Peace and Purpose in a Crazy Peak Fiat World. That will be followed by The Beginning of Knowledge, Proverbs 1:7 in Bitcoin, followed by Stay Humble Stack Sats, followed by 21 Creative and Responsible Ways to Stack More Bitcoin. Then Bitcoin estate planning strategies, and finally, Bitcoin private key management. Thought it was time for another one of those. Would like to send a shout out to God at God's Death with 237 sats supporting me on Fountain. Thank you, sir. And with that, I will thank you for listening to the podcast. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. You can also follow my Substack at bitcoinfortress.substack.com, and you can follow me on Nostr. My NPub is included in the show notes. And with that, I will talk to y'all next week. Bye bye.